Francis Hunt, CMT from themarketsniper.com, is back once again to talk about the breakdown of precious metals. This and more on this week's episode of Metal Money. I'm your host, Patrick Vieira. Francis Hunt, welcome back to Metal Money. How are you doing?
Delighted to be here. Thank you for having me back.
Francis, I want to start with gold. Again, it's on that roller coaster ride, up and down, up and down. What in your TA, your technical analysis, is showing you anything, or is there anything that has caught your attention short term?
Yes, it is. There's been a lot of action, hasn't there? And let's address some of that. I'm gonna put my eye back on. In fact, I'm gonna request a screen share so that we can drill down and have a little look at that. So let me bring that up. It's been a hard time for the precious metals people, and I think we're getting a little bit of narrative of this Evergrande scale. It's a little bit of a risk-off environment. Here's my take on all of that. Before we go too deep into the charts, my take is that particularly the American markets, the Fed has been looking a little bit egg on chin with regards to inflation and the mess they made for themselves in referring to it as transitory. One of the ways that gets combated is if we have a highly deflationary event that is global, for which this Evergrande event of Chinese property, which is nothing new in terms of what we expect is going on there, gets inflated as a narrative. What this has done is actually led inflows into the dollar. So the dollar index, which I'll do a short bypass as well, is currently getting a little bit of steam. Why don't I just do that as we are covering the narrative so the charts match the story. So the dollar index right now, which means largely against the euro, but there's the British pound, there's the Swiss franc, there's a couple of other currencies, are currently in an up move. Now, what this does is actually it lends obviously strength to the dollar if we're doing that. And then any imported inflation gets reduced. So in some senses, these events, whether they are managed or not, we'll leave that to other people to decide, are bringing strength back into the dollar, which will reduce inflation in the American concept. Your Mercedes that you're importing, your German product, your UK product, whatever you're bringing in is relatively cheap now. Even buying grains or commodities where you're short in your domestic market will now come in cheaper because you have a stronger currency. But all that's happened is you've now passed inflation to somewhere else in the world. So it wouldn't surprise me we get quite a lot of mumbling about the euro banking. Many of these narratives have been around for a long time. It's just when you choose to shine the searchlight on them to suit what you need out of the overall FX flows and ebbs. So if we start hearing a lot about the European banking crisis, you'll see the euro weaken, you might see the pound. There's quite a bit of negative aspects with Britain at the moment, for example, on account of their Brexit. So you get the pound weakening, maybe you get a little bit of the euro weakening, and this gives a head of steam to the dollar that actually will make the Fed look less bad in time when the inflation numbers that are being generated by the stronger dollar are reduced. But what it does do is pass the inflation stick to take a beating with to the European half of the Western world. And so they'll take a potential beating, and possibly China as well if the yuan is going to slip too. So we've seen a little bit of dollar index reflation. But I will point out this is probably a very temporary medicine that will help a little, but it's not going to save the day. You had a reversal on the dollar index here. You can see we had a little structure in there, and that's what we'd call an inverted head and shoulders for those non-technician. And you had quite a strong move of the dollar index into that high over there. But since then, you've been in what we refer to as an ascending broadening pattern. We call it a megaphone, an ascending megaphone on a bull pole. And these are typical reversals. Because of this thrashing around, getting ever more volatile, it points to a sense of dis-ease with these upside moves. In other words, the market is not comfortable and it's thrashing. So overall, I could see, whilst we might be short, medium term, a little bit dollar rich, that's not going to hold for too long. So expect a breakdown in the taper narrative as an example of what might a future narrative be that could then subsequently see the dollar losing a lot of its fizz and actually breaking in the end what we refer to as a basing and ascending grind line. You can see these interactions here, here, and there, eventually breaking that to the downside. But not until it's played out a little bit to the upside. It's all Evergrande, it's all China bad, falling apart, the debt. European banks will come into the fray, and all of this. This will be initially supportive for the dollar. So that's a little bit of narrative which is in play. Now, when the dollar gets strong, obviously, in terms of if the gold market is in a relatively benign environment, the gold market gets weak. We will, in fact, at some point have that amazing moment or weak spell month where actually you'll have strengthening dollar and the gold will be going up anyway in spite of it. And that's when you know you're in a real ripper of the gold market. As yet, we're not there. But that moment will come, and I put that little marker in your mind so that you can recognize, wow, in spite of dollar strength, the gold price is going up. So a little bit of moderate time. We're on a 4-hourly here. I also appeared on another Bullion Vault, and it was just prior to the sell-off that we had here. And I was highlighting to them that, again, we're doing a lot with broadening structures at the moment, technically, and this shows an inherent volatility. And we highlighted here, look, this was always going to have a smackdown. So we don't tell you what you want to hear. We said that's going to have a smackdown. Amazingly, we came to that key 1675 handle. I'll remind you of why that blue line is such an interesting line. Again, I'll go quickly up to the high time frames, but just let me finish this sample. We had a bull pole, and just as I was referring to on the dollar index, you had the same with gold. We're thrashing a little bit harder and wider and longer. We had the non-farm. It was almost the perfect miss of the non-farm number. We traded that little break up to the upside, and that literally was the last hurrah, the final drink of this party. And when I was conducting the more recent interview, I said, you've actually got this bearish pole, a continuation broadening structure, all in a reversal structure with this ascending megaphone. So there's quite a bit of complexity in text. I'm afraid to say I think we're going down again, which subsequently ended up materializing. We broke down again. You'll note, again, we've got a key level at 1750. So this is a bit of the optimism for the gold bulls, and I will come back to that. But I wanted to just highlight this 1675/80 handle and take you back up to the bigger time frame so that people aren't entirely lost as to where all of this comes. The seminal event of 2020 was, of course, the pandemic. And I highlighted when you got your first knockback there, and then you got the main event that occurred and all the news that followed it. You rallied back and you got a small knockback again. And then after that, you turned into very, very strong support. And all of this was taking place, the 1675/1680 handle. And in fact, we went into this rising wedge with a melt up, and we had our eventual blow off up move here, which was the last time gold guys really were enjoying themselves. But I have to always point out, big moves ends in blow-offs. So you should actually be looking for a short, medium-term exit, even if you're playing the long game. So you should be distributing a little and recognizing you may get a scope. It depending on your time frame. Look, if you bought physical and you're a long-term investor, you just smile, and then when it pulls back, you bite your bottom lip. But if you're a trader in any way or a medium-term investor, the blow-off is your tip-off to get out. So that was your 1675/1680 handle that came in there, and that's why that you have such a solid blue line there. Now, are we laying new levels of possible support? This to me is hard backstop to the gold price, because it was resistance very strongly in the bull markets twice, but you came back up to it for the pandemic, and then you ran through it, and then it was very strong support over here. So I think we've laid a level that is really hard behind gold's back. So taking you back into this and showing you where the slightly smaller layers of support are building up behind us, and you saw that there was actually a 1750 level in there that had crept in. Where did it come from? So I'll just show you where that came from as well, technically. If you're into charts like I am, you'll notice that that first bounce, the first time we bounced on the 1675 handle, you got a W bottom. In other words, you came back and revisited it again. And that gave you that neckline over there. That's a W bottom, classic technical pattern, very kind of simple. And then you broke from that and you made that target, which is the projection, and you continued on up into the top of that falling wedge that we have. And we want to get through this big red line, but we were in a nice channel heading up. The channel break was quite clear to see. There you touched once, twice, broken on the third time, which often happens. Little continuation pattern there. That was the beginning of a bit more challenging times again for us. Here, where did you rest? That 1750 line in that I've marked in blue, that was your neckline of your W bottom over here. That's where you got temporary support. Then you had a small dip, you tested one more time, but this was far faster rejected. You can see this is only wick, and then you bang, back up. And we now made a marginally lower low, all at the 1750. This is slightly encouraging. I think it's not normally a continuation pattern when you make a marginally lower low. And you tend to hammer out bottoms with marginally lows. So if we had done something more like that, that would have been a concern for a downside continuation pattern. But the fact that you make marginally lower lows, just running in the previous low and then rallying, starts to point to that maybe the worst is over. It's a bit early to say. We haven't had a lot of price behavior now down here. Let me just bring it back into a better, clearer view there. But the fact that you have this hammer and then the body of the candle is holding that 1750, and there's a little bit of drift off. Of course, post a spill, there's still a bit of post-earthquake volatility and rattling. There's still aftershocks to a degree, and maybe a couple of late traders having to get out that are a little bit in pain, and a little bit of leverage kicking around. But generally that dissipates. And if it's dissipating with a slight downward bias, that is generally prone to indicate basing. So we could base on that. Now, there is a chance of one final little stab, because generally selling comes in threes as well. So I don't want to be overtly bullish about that. Generally selling comes in threes. There's your continuation megaphone, the broadening structure on the bear pole. Then there's the second spill that you get there. This could form something, so a couple of scenarios. You could get, say, a rising wedge out of that, and you get a third final. You'll note that I have a 1734.8 there, and that is based on a head and shoulder like this, where that is your neckline at 1786. So you can see we touched that neckline a number of times, including there. And then this could be your head. We have the non-farm outcome that took you into the top, and that's your head. Again, you're touching this level. Should probably change colors just for indicating the neckline interactions there, and there. And then you are trying to hold this for so long. And then you just couldn't anymore. You're being lent on. So there is a bit of a head and shoulder out there. So if we're wrong about some form of basing, there is a likelihood that you'll push a little lower one more time. And that's maybe we're basing because of that marginally lower low, or maybe we're just respecting a key level. There was a strong neckline from the W bottom that I've already shown you, and we got another skid into a low. The worst sell, I would argue, is this one here. So if we do get a final selling structure, I would expect the 1738 to fall, the 1734 to fall, and then you've actually made the target of the head and shoulders. You're also coming to a level where last time you were very well supported in getting out, including this wick. There's almost an electric fence about 1680. So I don't think we get 1680, but there's an interim level there as well, also from a double bottom at 1712. So somewhere around 1734 and the 1710 level, this would be a good accumulation. If we had a real terror, mini subprime type narrative with Evergrande, and they really pushed it in the media, and it's all suddenly big news to everybody that China is over leveraged and there's money in property, and there was something super special about how too big to fail type sentiment, they might, in the worst case scenario, retest the 1680. I would not expect the 1680 to fail. So in other words, you might have intraday a short stab through, but that would be your Armageddon event. Pretty high Armageddon. I wouldn't say Armageddon as in nuclear holocaust, but I mean the economic equivalent, this is a real big deal. So starts approaching, wow, there's going to be a domino effect throughout all Chinese property companies. And now suddenly a lot of American companies are being found out to have invested in this. And now there's a knock-on effect for American banks. And, you just get this whole viral, all fall down, ring a rosies season again. And a tissue, we all fall down. But that could then clearly see a 1680 run, but I would treat it as an accumulation point. Failing that scale, 1710 to the 1734 is a medium bad outcome, but a good accumulation point. And on a slightly more bullish note, maybe this turns into some form of basing just here at the 1750, if it continues to hold and round. So you start to have a bit of a rounding. So maybe you have another little leg, you might make another marginally lower low, or just meet at the previous low, so you have a bit of a double bottom structure on a smaller time frame. It's all a little too soon to say, but that's your best outcome. So I've given you sort of the three scenarios: good, medium bad, and bigger bad for that. And then we've got to remember where we are on the macro. So people will say, well, that's not overly optimistic, Francis. You're not making me feel good. Well, I don't want to be the guy that makes you feel good. I'd rather tell you exactly how I see it. Truth is like my coffee. It usually comes dressed in black and is pretty bitter. But in the long run, overall, this broadening structure to the downside, you'll see this red line here, is showing that the market is unhappy with an ongoing downside, and there's more uncertainty, and there's clearly stabs of value buying coming in. So initially you were quite hard on the sell, which was your blow off. Then you had normal continuation sell off, and then we started to get these stab backs, which has expanded, and this was quite a long rally from the last 1678. So we're starting to see more assertive buying, which is again why I say you have a bit of a hard wall. And typically these broadening structures end up being broken with the market through a consequence of time and upside valuation. You're walking through that line and you're breaking what was a broadening structure. We call them slides. It's a bit like what you jump out of in a plane in an emergency situation. You sort of, eventually you come out the bottom. You get to the floor. And when you're expanding volatility going down, it's actually uncertainty. There's quite a lot of people that's starting to think this is undervalued now. So macro, I think that's going to be a lot better. We'll see what happens on the shorter time frame. Many of you will be silver investors like my good self and fans of the silver. And we've just literally put a toe out of the bottom of a falling wedge here on silver. And again, starting to get a little bit of a bid. Now, I know when we were talking just prior, you were mentioning my analysis on the gold-silver ratio. Do you want to repeat that question? Because now's a good time maybe for me to take a look at that and then bring you back to the silver chart.
Yeah, last time we spoke on July 12th, we sort of planted the seed for perhaps seeing a single-digit silver-to-gold ratio. But however, today it's gone up since then from about 69, where we're getting close to about 80 today. So as you track the candles, do you think we are going to see this ratio hit triple digits again?
I don't, no. And I'll show you why technically. So the answer is a flat no to that, but it can never be a guaranteed no. Anything potentially is possible, but that would be almost like a 3 sigma event for me. So just to remind you where that would need to be, you would need to be back up here. On this level line. So I'll draw it for everybody to see it on the charts. And to do that, before I draw it on the charts, I'll also show you on a bigger time frame where I think we are and where we've been with the gold-silver ratio. Now, unfortunately, this particular trading platform, I haven't got all the way back to the 60s in terms of ratio, but the macro technical on this has been very, very clear. We had a blowout. We split all our rising wedges. Let me redraw that line. It's not very well centered. We call them splitters on the rising wedge. But you've been essentially for multi-decades. We can go, here's the 2008 crisis. Everybody remembers that. We've got to remember now that is now 14 years ago. You've been in the better part for 14 years of the financialization of everything, the quantitative easing realm throughout this. And there was a non-stop erosion of the gold-silver ratio leading to the pandemic blow-off high. And I mentioned when we last spoke that major trend reversals are bookended. Think of that set of encyclopedias and that hard wooden stop on either side. They are bookended by a final blow off in an upside or a final capitulation in a downside. This is very, very key technical aspect. Think the dot-com booms, think Bitcoin to 20,000, 2017, all aspects of that typically have that. So it gets extremely bad in an intense way before it ends, and the darkest hour before the dawn, literally in technical analysis and in markets. That was almost certainly that event. And I would point out historically in the gold-silver ratio, such is the perversion of the financialization of everything at the moment, that we never in the history of gold and silver seen 128.58. Now, depending on where you're getting your gold and silver prices, you might have some variations, but we're talking safely. No one had less than 120. And I'm dividing the gold futures continuous contract by the silver futures continuous contract. That can't be too far off the mark. That is an extremity of all-time historical high. And the subsequent reaction pointed to it being the death knell for it. So you can see 128, if you watch the high number in the top right of my chart, that was 128.69. It was almost 130. You're talking about 129. And then absolutely got smacked down, and we began a major sell-off with real momentum. Remember, most of these years you were grinding your way up, little surge, grinding your way up, little bit, come back down. That was the bull market, a little bit of a bull market on China debt concerns. Funny, we're talking about Evergrande again and debt again. So the stories sometimes don't change. That was the top of the bull market, 2011, when you'd had quite a broad spill here. Then we've been nothing but inching up for absolute years. So the abruptness from 128 to round about 63, I think at the low here, was so abrupt and in such a short time frame, it's natural for you to have some degree of reaction. Even a dead cat bounces, as they say in the market. So in essence, for now, given the scale of this would still fall under the category of some form of dead cat bounce. That doesn't mean you're about to snap out of it, but it's pretty extreme. So if I just put the lock on and I throw a fib for you on that structure and show you how far you went to the downside, and where you are now, you've retraced 23.6% from the extreme high. That is not something to be concerned about. I'll start reviewing that opinion, and you've always got to ask, at what level am I wrong with that view? And the rising wedge, the blow off, and the smackdown. I really don't feel it, but you can always be wrong. By the time you've retraced 61.8, it can then just be what you typical would say is a correction in an ongoing bull market for the gold-silver ratio. So if we got back up to 103, you mentioned that, I think you mentioned the round number of 100, it starts to be a serious concern for me. But given what has happened, I think this is, and we refer to this as the slap in the face for a market. It's usually a trend-changing event. I joke about the man who's chatting up the girl at the bar, and it's all going so well, and then he oversteps the mark and puts his hand on the wrong place, and then it's all over from there. You know, she leaves on her own, and he looks sheepish. So in that sense, the market, it's a real turning point. You know, it might have been going well for you, but from there, it's all downhill. So those kind of technical events are short, sharp, and abrupt, and they're a proper cold shower for the progress there. So even going back, so your question I've dealt with on quite a macro time frame on this. I will say you are right. It's already lasted a little longer than I would have expected. So you can't get too complacent about this. But I do think the 70 mark is, if you remember, on again going back up to the bigger time frame, it just seemed to have been a pivotal event mark zone around which we pivoted for an extended period many times. It's not going to be surrendered easily. You'll see how you always break key events with momentum. You always, in fact, you wound up to get over the 70. You see, that's kind of squeezing higher to get break with momentum above 70. Then you couldn't really get away from it. You got sucked back down. Then you got the sort of flagging behavior where you're pivoting either side of it. It's quite clear to me that the ratio is an extended ratio of relevance. You can see how many years, multiple years, in getting through it, then supporting on it, pivoting around it before you eventually went further. It's unlikely that it wouldn't become a significant event of some degree of support and churn when you got back down there. But you've got back down there from almost 130. You know, you've close to halved the gold-silver ratio from its blow-off high. So that's hell of a good progress in an extremely short time frame. So I think it truly is more and more patience. We were looking at this as a channel just technically, and we had hope for us this being a structural setup for something that resembles, and some of the folk with a technical analysis bent would have said, yeah, maybe like a bear flag, you know, we'd skidded into these lows. But this is your problem with marginally lower lows. You skidded in here. There's usually a bit of a base and a counter attack story going on. And instead of getting that, as we were indicating here with a gray line, that down leg, we've actually bled out of the channel. And we're out of a typical price structure now. But that's a shooting star, that little guy there. And it's showing some exhaustion at 79. You were worried about this 80 level. You're getting a little bit of technical exhaustion on there. And that's a good sign. We want this chart to go down, as a reminder to everybody. You're probably aware of that, but just to make sure people aren't getting confused. And again, if I draw things surrounding our broadening structures, you are actually getting more volatility as you are going up. And this is failing to reach the other side now. So this points to, again, that's an ascending megaphone. It's usually reversal structure on a bull pole. So it's thrashing more as it's trying to find a valuation. That usually means it points to overextension. So I think the cavalry is coming. But like anything, when you're under duress, it never arrives quite when you want it. But the cavalry is coming. How well it'll research, how successful. Well, you've got quite a few localized highs. Here's some localized highs on the way down. And you've taken out a localized high. The problem I would have, we start to be in problems. So how does this go wrong for us? While I'm asserting the cavalry is coming, how do I be wrong about that assertion? Well, if we were to get up to a technical level around here, where you might say the 82, I would guess you have a little bit of a left shoulder, then a lengthy head. This could get awkward, but as I say, it's already battling and broadening inside here. But were it to find a way to get up to 82 and then have a small rest, we would then technically have a little bit of a reversal structure at the 70 with an 82 neckline, and you could get a rally. Now, that's 12 difference between 82 and 70, and that would take you right up to 94. And there's usually a little bit of overrun. So that starts knocking on the door in 95. I don't assess that. People generally draw reversal patterns too often. The macro trend is your friend, and this was a shocking slap in the face reversal of an extreme overvaluation, relative overvaluation between gold and silver. So in the longer run, my expectation is this continues a downward journey. And the more you overexert to the one side, far greater the corrective over exertion to the downside. So this is why I actually will still hold out that given enough time and major structural corrective events, a lot will change in a couple of years that you won't recognize where we were. And it can happen very quickly. And that's when metals can move like cryptos. And I think that event will come. And I still say you can trade sub 10 on the gold-silver ratio. And I would say in that event, gold will also be significantly higher. You could be looking at $5,000-$10,000 gold. And then, you know, you're looking then at $500 to $1,000 silver.
Francis Hunt from themarketsniper.com. We appreciate the time you've given and your insights, your opinions. Good stuff. I hope we can do this again soon.
I really appreciate you bringing me on. It was lovely to see you guys. And to all our precious metal fans and sound money fans, keep the faith, keep stacking. You'll be wrong. And then everyone will see you for the hero you were for thinking big time frames. All the best. Bye-bye from me.
All right. Thanks again, Francis. That was Francis Hunt from themarketsniper.com giving us the breakdown on why the breakdown in precious metals. As always, please leave your thoughts in the comment section below and remember to keep it liquid, keep it real. And I'll see you on the next episode of Metal Money.